saves properly. 21. Okay, so we are, did I hit record? I think I did. Yeah, we're recording. Okay, so let's just go ahead and take a look at Chapter 21, Partnerships. We'll deal with Chapter 22 next time, S corporations. And these are basically pass-through entities, okay? And so what happens here is we're going to see that the partnership, and the same thing for S corporations, will file a tax return. But the whole point of the tax return is simply to show the different amounts that were distributed to the partnership members, the partners, what was distributed to them so that they can fill out their respective tax returns, probably their 1040s, whatever it is that they're going to file as individuals, okay? And that's also going to be the same for the S corporations. So the couple of things that we're going to look at here is one, when you're forming the partnership, what are the tax consequences? And we're going to see that it's very, very similar to what we've already said about forming corporations. There really is not a tax consequence to that in most cases. And then we're going to take a look and see what the various forms are that you would report information. And I know we didn't spend a lot of time with tax forms in this class, but I figure for the partnership and the S corporation, since it's all about the reporting of the return that then forwards to the tax return of the individuals, we'll spend more time understanding what items go where on the forms, and that'll pretty much be what we talk about for partnerships. We can spend a whole class talking about all the different partnership accounting things, but we're not going to have time for all that. So let's just go ahead and take a look. And as I've mentioned, partnerships are what? Flow-through entities. Okay, and we're going to talk about different types of partnerships towards the end, limited liability companies, etc. But partnerships are covered under subchapter K. So sometimes you'll hear that mentioned, or you'll see different schedules that they'll talk about K this and K that. It's because it's subchapter K. Okay. Now, what happens? Each owner normally has a capital interest. So and so owns 40% of the partnership, 50%, 20%, whatever it is. Okay, but there could be situation where they will have profit and loss interests that will differ from their ownership interests. And this sometimes will happen if you have somebody coming in who really doesn't have any capital and they're going to work their way into some sort of ownership. So they'll say, hey, this individual will get a certain percentage of the profits because they probably don't have any capital to contribute when they come in. Now, these are not tax, issues. It's not called out in the code, who gets what percentage. It would be specified in any partnership agreement. You can enter into a partnership with somebody. I don't care if it's your best friend since childhood that you've known since you were 2. You write it up in a partnership agreement, right? Because everybody forgets what it was that was supposed to happen when things start going in a different direction. Okay, so that needs to all be in writing. Okay, now partnership formation. Okay, and when a partnership is formed, partners can contribute money, they can contribute property, they can contribute services. Okay, and you could also have someone acquiring a percentage as a new partner of an already established partnership. Now, the general rule is that no gain or loss is recognized on contribution of property to a partnership. Okay, so no tax consequence when the property comes in. Very similar to what we saw when we talked about corporations. So you see this example. A taxpayer contributes land in exchange for partnership interest. The land has a basis of $30,000 and a fair market value of $50,000. Now, if the person had just sold that land outright for cash, they'd have what? A $20,000 gain, right? But since they're contributing that to the partnership, there's going to be no gain or loss. Why? Because they're contributing property, right? Now we'll see in a minute, of course, there's going to be exchange of basis. The partnership now will have a 50%, not 50%, but now have a, what's the basis here? $30,000 basis in the property, and the partner will have a $30,000 basis in their share of the partnership, right? Okay, we'll talk more about that here in a minute. Now that's property, okay? If we get a share in future profits, okay? So what happens? I'm going to work my way into a share of the future profits of the entity. So now I'm not contributing property, but I'm contributing what? Services. But notice the key here is what? For future profits. So they're going to let me share in future profits based by working my way in over the next couple of years or something. And usually that's going to be what? A younger partner who doesn't have a lot of capital but wants to get it in there. They let them work themselves in to a share of any future profits. Well, that's also not taxable. And you think about it, you're saying, but wait a minute, you're providing service. Isn't that taxable? No, because what? Who knows? Maybe the future profits will be zero. At this point, I've just worked my way into a right to receive income in the future. I have not received any income, so that is not taxable. Okay, so you take a look here. Taxpayer has no property. He receives a 20% profit interest in exchange for services rendered. On the day on the day he is admitted to the partnership assets have a basis of $20,000, liquidation value of $80,000, setting you up to think that, well, that should be what? Worth $16,000? No, because they haven't been given any share of that $80,000. They're only getting the right to what? Receive a share of profits that may or may not occur in the future, right? Okay, so in the future, when they get a share of profits, whenever the partnership agreement, I don't know, maybe they make them work a year, maybe 2 years to get into that. Once they start actually sharing in the profits, then that, of course, that share of their profit becomes taxable. Okay? Okay, good. Now you come over and exceptions to the no recognition gain, and that is if person provides service in exchange for what? A capital interest in the partnership if it liquidates. Well, now you've earned something, haven't you? You've earned a share of something that already has value, the liquidation value of those assets. Notice they use liquidation value. If they were to sell tomorrow, you would get a kick out of that for the services that you provided during this current year. So if that's the case, then what? Then the value of capital interest acquired for services will generate ordinary income. So notice we're taking the same facts as before, except instead of what? Receiving a right to receive a share of future profit, it is what? A share of the capital interest in exchange for services. Now we take that $20,000 times the 20%, and this individual has what? Ordinary income of $16,000. The idea being that tomorrow the corporation could liquidate, couldn't they? And you should get, your share of the liquidation value of the assets. Okay. Okay, good. Let's take a look at the basis of property that is contributed. Okay. And so when we make the contribution of property, we're not going to be taxed on that. Any potential gain or loss is postponed, right? It's not permanently excluded. So what happens? Following the contribution, both the partnership's basis in the asset and the partner's basis in the partnership asset will take the basis as it was derived from the partner's basis in the contributed property. So whatever the partner's basis was, that becomes the basis of for the partnership. And what? Now the partner's basis in the partnership is whatever the basis was in the property that they gave up, right? So they simply exchange basis. And this is sounding familiar. It should. It's the same thing that we talked about with the formation of a corporation, right? The only difference is now it's a share of a partnership as opposed to what? Shares of stock in a corporation. So the big difference is your ease of transferability. With the stock, you can just go sell it to anyone, right? The partnership share might have particular stipulations, and I'm sure it would, as to what you could do with your share of the partnership, right? I mean, the other partners aren't going to say, yeah, sure, go ahead and sell off your share of the partnership to anyone you choose, and all of a sudden they're stuck in a partnership with, I'm trying to think of a character that no one wants to be in a partnership right now with. I want to say Trump, but you guys wouldn't like that, right? Okay, share percentage with somebody that you don't want to be in a partnership with, or Putin, whatever. Okay, so they sit there and they probably have limitations as to how you could trade that. Stock doesn't have that kind of limitation. You could sell it to whoever, right? Okay, all right. So you come over and you take a look at the partnership's basis in the asset. And this is really now giving more detail to what we already said. The partnership takes a carryover basis in the contributed asset it receives. This means the partner's basis in the asset carries over to become what? The partnership, and we call that the partnership's inside basis, meaning what? It is inside the corporation now, the partnership now, that particular asset, whatever it is, right? The partner's basis in the partnership interest, and the partner takes a substituted basis in the partnership interest. This means that the partner's basis in the contributed asset transfers over to become what? The partner's outside basis in the partnership interest. Now he's got what? Something that's evidencing his share of the partnership. He's holding that outside, but it's still the basis that he had in the property. So you simply picture what? The partner giving up the asset coming into the company at the partner's basis, and what? Outside the company now, the new partner has his share of the partnership, and his basis in that share of the partnership is whatever the basis was in the asset that he gave up. Now, how do we treat those items? Are they long-term, short-term? And the partnership's holding period for the contributed asset includes the period during which the partner owned that asset. So if the partner had owned the asset for 2 years or something, then it's going to maintain the holding period going forward. The corporation holds it for another year after that. Now the partnership holds it another year after that. It's assumed that the partnership held that for 3 years, right? In that little example. Okay. Partner's holding period in the partnership interest. The partner's holding period in the partnership interest depends on the type of contributed asset. If the partner contributes only capital assets, buildings, land, that sort of thing, the partner's holding period in the partnership interest is the same as the partner's holding period for these assets. So if I held a piece of land for 3 years, I contributed to the partnership. My ownership in the partnership will start with 2 years, and we'll just add on from there. If I have just contributed cash or assets that are not capital assets, then the holding period in the partnership interest begins on the date the partnership interest is acquired. If you're giving cash, they're assuming, hey, you are just now buying into this, and we're going to start that clock running on the date that you buy in. Okay? If it's both assets are contributed, then the partnership interest is a portion. Whatever portion was attributed to, say, cash will begin on the date that you make that investment. Any contribution of capital assets, you'll carry over whatever your holding period was before. Okay, good. So let's take a look at Luis here. Is that Luis? That's how I pronounce it. Luis. Transfers a capital asset in exchange for 1/3 interest in JLK, which is a type of partnership, limited liability corporation. And we'll talk about the difference between general partnership, LLC, LLP, very briefly at the end. We're not going to get all up, and I'm not going to turn this into a law class, but we'll see what some of the advantages and disadvantages are of these different forms of partnerships. But the asset has an adjusted basis to Luis of $10,000, a fair value of $30,000. Luis has a realized gain of $20,000, and we're under section 721 here that deals with this for partnerships. we do not have to recognize any of the gain for our tax purposes. So we'll be able to defer that. Now, what about the basis? Luis' basis in the LLC is the basis of whatever the property was that he gave up, $10,000. And they tell us that this rule ensures that what? The $20,000 deferred gain will be recognized on the subsequent sale of the share that he bought, which was presumably having a fair value of 30. You know, we assume in these examples that Luis isn't, desperate for money. He's not a crack addict that's going to go around, giving away stuff that's worth 30,000, and only get a share that's worth something that's worth $10,000, right? So the presumption is that he's getting something back of equal value because his contributed capital, because Luis contributed capital assets, then his holding period tax. So basically the holding period for his share in the partnership will add on to the whatever the holding period was for the land. Did they say what the holding period was for the land? Whatever, it will add on. It'll continue to add on as the partnership holds that. Okay. The partnership's basis for the contributed capital is the carryover basis of $10,000. This basis ensures that Luis's $20,000 deferred gain will be recognized if the LLC sold the property for its $30,000 fair value. Then the partnership would have a basis of 10. There'd be a $20,000 gain. That $20,000 gain, what's going to happen? It is going to be distributed to the partners. So if Luis thought he was going to avoid paying the tax by what? By shifting it over to the partnership and having it sold, no, he'll get taxed on any gain, his share of any gain on the sale of that property at that point in time. So, okay, if it was cash, the holding period would begin when? For Luis? On the day that he pays that cash in. Okay, all right, good. So let's take a look at a couple of questions here. And again, these are in your homework. The test bank was a little thin for this chapter, I felt, so don't be shocked. I haven't deployed the homework yet, but don't be shocked when I deploy the homework. There aren't a lot of questions there. I don't know why the test bank was so thin. I may have to look around for some other questions for your exam, because I don't want to ask you the same questions on your exam that you've already seen, right? Okay, so number one, a partnership will take a carryover basis in an asset acquired when the partnership acquires the asset through a 1031 like-kind exchange. Guys, we didn't cover that. That's part of property transactions, but there was nothing that we saw in the material that called out that sort of property as being one that would be considered a like-kind exchange. It would be considered part of this process, so for section 721. A partner owning 25% of partnership capital profits less than okay, that is just, wrong. I mean, you can put anything you want on paper. That's just, paper takes anything. So that's not correct. C, the partnership leases the asset. D, the partnership acquires the asset from a partner as contribution to partnership capital under section 721 is where we have that the carryover basis coming from the partner to the partnership. Number two, on January 1st of the current year, Anna and Jason form an equal partnership. Anna contributes $50,000 cash and a parcel of land, adjusted base of $100,000. Fair value $150. Now, I wish they wouldn't have made the fair value $150 because this makes this a poorly written question. They should have made the fair value $140 because the answer is going to be what for Anna? $150, isn't it? It's going to be what? The cash plus her basis in the property that she gave, but you could get that confused with the $150 fair value for the property. And so that's not a best teaching moment here for this particular question. Now, I've told you what the answer is. They give us Jason's information, but Anna is what? 150 tax basis. It is in the partnership. It is the $50,000 cash plus what? Plus the 100,000 basis in the property that she gave. Okay. Okay, good. This is a better question. Zena and Xavier from XX LLC, whatever. Zena contributes cash of 20,000, land basis 40, fair value 25, equipment basis 0. How could she have basis of 0 in a property? Maybe the thing's fully depreciated or something, right? But still of some sort of use to the company. So the basis to the partnership, the basis is 0, fair market value 35, inventory basis 30, fair value of 40, Xavier, blah, blah. Who cares? Because they asked me what is what? What is Zena's basis? And Zena is going to bring in her what? Her basis on all of these. And she's going to get back that in her partnership, as the basis in her partnership interest. So it's the what? It's the 20,000 of cash. Of course, the fair value and basis of cash are identical. So it's the 20,000 cash. It's the 40,000 basis in the land. It's the 0 basis in equipment and the $30,000 basis in the inventory. All of that transfers into what? Her 90,000 outside basis in the partnership, right? Okay. All right, good. Let's take a look. One more. Okay. Tara and Robert formed the TR partnership 4 years ago because they decided the company needed some expertise in multimedia presentations. They offered Katie a 1/3 interest in the partnership capital if she would work for the partnership. Okay, so Katie's going to work her way into what? A piece of the rock, isn't she? A piece of the ownership. Okay, and so if that's the case, now you're receiving something of value. And so if the fair value is 25,000 that you've worked your way into, then that is a taxable event. That is ordinary income, right? If it was a what? Percentage of share of the right to receive income in the future, then that would be what? That would be 0, right? Okay, and then she'd probably start paying tax on any shares, any share of the income that she has in future years. Okay, operations. So we got the formation issues down. Let's take a look at operations. Okay, and again, tax-exempt reporting entity. So the tax is not going to be paid by the entity, it's going to be paid by the partners. Still, the partnership has to file this Form 1065. And each of the partnership tax items is reported on Schedule K. So we're going to have the what? 1065. That's sort of like almost like the Schedule C for a sole proprietorship, where we'll calculate the partnership's income, whatever. But then that will be rolled over into the Schedule K, as well as will any other taxable items or tax items that have tax consequence, I guess is the best way to put them. They are also reported on Schedule K. So if the partnership makes a contribution, charitable contribution, that is not part of the 1065. That is going to be reported on what? On the Schedule K. And then the Schedule K items will be distributed, including the carryover of income from Form 1065, will then be distributed to each of the partners on K1. So each partner receives a Form K1. If there's 3 partners, then there'll be 3 K1s, one for each partner, that reports the partner's allocable share of partnership income, gains, losses, deductions like the charitable deductions, tax credits, etc. All of those items get pushed over to first the Schedule K and then the K1. Okay, so you take a look, and this is probably Before we get to that, I just thought we were going to the next slide before we get to that one. Ordinary income consists of any income expense that is not required to be reported separately. That goes on Form 1065. Easy way to remember that is normal operating type items, right? So what's happening? Our revenue for the period, our expenses for utilities, our salary, all of those things. By the way, even if the salary is paid to the partner, we still deduct that there, right? And that's going to just basically create an operating income number that then is going to get carried over to Schedule K, okay? Then what? If there are any separately stated items, which we'll see on the next slide, those also will get over to Schedule K. These are things like charitable contributions, etc., that are going to go over to the partners. And then all we do from Schedule K to K1 is allocate proportionately the amount that goes to each partner. Now, I'm going to spare us all of the detail as to how you would calculate the partnership's percentage share, because it will depend on what was their beginning balance, what was their share of the income for the period, what was any withdrawals that they had, gives you a new percentage. I'm not going to make us go through all that. We will simply get whatever percentages they are, even if I ask you to calculate that, and just know whatever the percentage share is for each partner, that's what goes to each partner's K1, right? So the K is 100%, K1 is based on the distribution requirements per the partnership agreement, etc. Okay? So you come over, and this was the slide that I was getting ready to trumpet a minute ago, but notice the items that are passed through separately, okay? Short-term and long-term capital losses. Charitable contributions is probably the easiest one to remember there, and that what? That goes over to the individual, and then the individual has to follow the individual rules that we talked about, the ability to deduct charitable contributions, etc. Okay? Passive activity amounts would get carried over to each individual partner, okay, etc. Okay, and I'm not going to get into every single one of these, but I would expect you to, recognize some of these key ones, or a couple that I underline anyway. Charitable contributions being the best example. Okay, maybe passive activity losses. Okay, the partnership is not allowed to claim deductions for net operating loss. Okay, some of these other things. In the dividends received deduction, I guess there's some sort of depletion of oil and gas interest. Okay, items that are taken by individuals, such as standard deductions, personal exemptions, also not available to the partnership. Okay. All right, so you look at that, and I took this out of the book. They had an example, and I've kind of stuck in the little comparison format, the 1065, and so you can see that on the 1065 we're going to have, and it's just like basically a very basic income statement from 102A, where we have what? We have our sales, we have our cost of goods sold, gives us gross profit. Remember when you were young and you learned those things? Okay. Then you start taking off what? You start taking off the salaries, guaranteed payments to partners. Okay, we consider that like a salary to the partners, but if we call it guaranteed payments to partners, that comes off. Okay, taxes, license, whatever we have to pay, those sort of things, depreciation. Okay, then what? Then you have any other deductions. There might be a statement there, and then you have an attached schedule there, and then you have your total deductions, and you have your business income loss. Okay, now this is what? This is the income from the partnership that the partners are going to share, aren't they? And so that number is going to go over to the Schedule K, as are some of those other things that we saw in the previous slide, like the charitable contributions, that sort of thing, right? These are items that are now what? Ultimately going to be apportioned out to the different partners. Okay, so you can see we have the 180,000 here, and then we start bringing in some real estate that the partnership apparently held, but we're not considering that part of the income of the partnership. We consider that income to the partners. It's going to be distributed. We have what? We have our charitable contributions. Okay, $6,000, right? Okay, I pointed to that, etc. Okay, and you have these different things here: net short-term capital losses, interest income. These are all things that aren't day-to-day operating items of the partnership, right? Okay, and so all of those things get reported on the Schedule K, and then you have some of these other items down here. I just continued on with some of the other ones here down towards the bottom. And then you have what? Then you have the K1, and the K1 is for a particular shareholder, Maria, whoever she is, right? And this K1 is going to give, for example, her share of that, what was it, 180,000? I guess she got half of it or something. And what? Her share of the rental income, her share of any guaranteed payments, etc. So it's just simply taking what was on the Schedule K and distributing it now to the shareholders. It's like their W-2, their 1099 or something like that, right? And then they know what they need to do with those items to fill out their individual 1040. Okay? All right. And again, I'm not going to make us go through all the problems of figuring out these percentages. They have some exercises in the text and stuff, but every partnership is going to be different, and it's going to be based on the partnership agreement and that sort of thing. So I don't see a whole lot of value in making us jump through a bunch of hoops there to figure out those percentages. So that won't be something we'll cover. All right, now you come over and there's a potential, well, two things really take away from this slide. One, the drawings, distribution of cash is not the taxable event, right? The taxable event is the what? Partnerships, earnings, etc., tax items that flow over to Schedule K to the K1. But obviously, from time to time, the partners are going to want to take a cash distribution out of the partnership, right? They got to live, okay? And so what happens? Typically, that is not taxable, the drawing of the cash, unless what? Unless the taxpayer draws out more than their share of their equity in the partnership. Well, now they're getting what? Now they're getting a taxable event because they're essentially getting a distribution that's greater than what they've put in. Okay, so it's almost like a gain at that point in time. So what happens? Samantha, just look at Samantha. She has an interest of $50,000. And on the date, they distribute what? $60,000 to her. Well, now she's got a $10,000 gain that she has to take, a capital gain that she has to take, because in effect, she's kind of sold off a share of her share in the partnership, and so that then, and she sold that off at a gain, and so they're going to consider that a taxable event. She'll have to pay tax on the $10,000. So typically distributions, what? Not taxable unless they exceed the partner's share in the partnership assets, then that gets taxable. Okay, all right, let's take a look at a couple questions here. This POD receives revenues of $200,000, paid $50,000 in rent, and a $20,000 distribution to the partner. In addition, the partnership earned $6,000 of capital gains during the year, and they have a 50% interest. And so the question asks, how much must Donald report for the tax year? And the ordinary income is going to be what? The revenue minus the expenses of 150,000 here, but they have what, 75,000 of ordinary income and 3,000 of the capital gain, and so he's getting what, 50% of the 150,000. That's where we're getting the 75,000 from, and then the capital gain is going to be reported. The distribution is what? Their share of the capital gain. The distribution is not taxable, right? Distribution is not a taxable event, but those items would go over, his share would go over to his, I guess, his K1s, even though they didn't ask that. Okay. All right. Different forms of partnerships. Oh, not yet. Item 6. On a partnerships form 1065, which of the following statements is not true? The partnership must reconcile its taxable income to book income on Schedule M1 or M3. We didn't talk about the M1s and the schedules for partnerships, but that's you don't file all of those for the partnership. B, the partnership's balance sheet on Schedule L is generally presented on a financial book basis. That's not true. Schedule L is on the tax basis, or the basis, not the financial book basis. All partnership income and expense items are reported on Form 1065. So the revenue expenses were on that 1065. Okay. Oh, all of these are true except what? Except this one. And what makes this one the lie, sorry guys, what makes this one correct is it says all partnership income and expense items. Well, there are items that are reported where? Over on the Schedule K, aren't they? Okay, so some of those items get reported over on Schedule K, so that's why that's incorrect. The rest of these are okay. Okay. All right. Different types of setups. Limited liability companies, LLCs. And this happens when they want the protection of a corporation, but they want the income to pass through as though it were a partnership. Okay, so in the limited liability company, it goes further in combining partnership taxation with the limited personal liability for all owners of the entity. A properly structured LLC with 2 or more owners is generally taxed as a partnership. So the income flows through to the partners, but they get the the liability protection of a corporation when they go with the LLC. Now, some disadvantages, and again, generally, none of the owners of an LLC are personally liable for the entity's debts. General partners and limited partnership have personal liability for partnership recourse debt. So if you didn't set it up as an LLC and there was a debt of the partnership, they could come after your personal assets, right? If it's an LLC, you are limited, your liability is limited to the assets of the corporation, and you can protect your personal assets, okay? Disadvantage is that there is a limited body of case law in various states, and among other factors, statutes differ from states to states, and so an LLC can conduct, particularly to the extent to which certain services providing firms can operate as LLCs, and a service entity may find that it can't operate as an LLC from one state to the other. Okay, so the laws in various states are not necessarily in a position where you can operate as freely as you could if you were just a straight partnership, right? Okay, so that's one of the major disadvantages, but you do have the liability protection, okay? Now, you could also do LLP, limited liability partnership, and it is similar to a general partnership, but there are very important differences. And first off, I don't know if we recall, because you may have not read this earlier, but Partners are jointly and severably liable for all partnership debts. So what happens? Someone can come after me for a debt that you leave behind, or I'm going to put you in the bad place. Someone could come after you for a debt that I leave behind, whatever, right? Okay, so if you want to protect yourself from that situation, we're also personally liable for the own malpractice and torts. However, we don't want to be personally liable for the malpractice and torts of the partners. Okay, so as a result, what we do is we form an LLP. Okay, let's just look at what we say for the LLP. Well, that's the bad part. So what LLPs do, let's get rid of that. LLPs are treated as partnerships under federal income. So while they operate in a manner similar to a general partnership, they're quite different from an LLC or limited partnership. All states permit LLPs to be formed, and they must have formal documentation, etc. But it's much easier to operate, across the board in different states. But because LLPs are general partnership in other respects, they do not have to pay state franchise taxes on its operation. An important difference between an LLP and an LLC. Okay, so we're getting what? We're getting the flexibility of operation that you would receive for a general partnership, but what? We are protected in the fact that if I leave some debt behind or I malpractice as a CPA and I do something wrong, I am not personally liable for any, torts or anything that are left behind by you, okay, or vice versa. If I want to put myself in the person that did the wrong thing, okay. I think most CPA firms are LLPs now. Okay, so they're trying to set that sort of thing up so they can operate, have the flexibility to operate, but not sit there and be liable for something that happens with a partner in the office in Chicago or something, and you're out here in San Francisco, right? So you want to be limited there. Okay, all right. So let's take a look at number 6 here. Which of the following is not a correct statement regarding the advantage of a partnership entity from that of a C corporation? And what? A, partnership typically easier administrative and filing requirements. Which of the following is not correct? That's probably true, right? You don't have to incorporate with the state and all that. B, partnership income is subject to a single level of taxation. Corporate income is double taxed. That's true, right? We have the tax on that the corporation pays, and then we have the tax on any dividends, right? Whereas with the partnership, everything flow through the partner, and any withdrawals from that were not taxable events, right? Any distributions, unless they withdrew more than their share. C, partnership may specially allocate income and expenses among the partners, provided the substantial economic effect requirements are met. Corporate dividends must be proportionate to shareholders. We pay our dividend per share, don't we? Okay, so it would be proportionate. You can see the answer is D. Partners in a general partnership have less personal liability than shareholders of a C corporation. Absolutely wrong, right? I could be held personally liable for the debts of the partnership, right? C corporation, my exposure is limited to whatever stock I bought. If something goes bad, they don't come. When Southwest Airlines had a crash today, right? They didn't crash. They put a hole in the fuselage of the plane and somebody got sucked out, but they pulled the person back in time, so she didn't get all the way sucked out of the plane, so I think she lived. But, something like that happens. They don't come to your house and say, excuse me, you got, $10,000 you can give because we got to pay this lady $1 million for getting sucked out of the window of the plane, right? And so you're limited to whatever stock investment you would have, right? Okay. Okay, guys, that's it for partnerships. If there's no questions, we will obviously get into S corporations next time, and then the time after that, I figure we'll finish that next time, and maybe we'll do a little bit the time after that, talking a little bit about alternative minimum tax, although I'm not going to put that on the exam. And I'm going to try this again and see if it saves properly.